Welcome to Understanding the Empire. My name's Josh, and I have a huge interest in politics, especially as it pertains to fiscal policy. One of my goals is to create a simple yet informative approach to understanding things like our government, how federal budgets work, how the national and local politics are connected, as well as the history of monetary policy. Most of all, we want to discuss how all of it affects you. To lay the foundation, we will go over some basics to build out an understanding of these things. First off, our government is comprised of three branches: executive, judicial, and legislative. The basic task of these branches are to create, interpret, and enforce the laws. The legislative branch is comprised of Congress, the House of Representatives, and the Senate. Their job is to create. The executive branch is comprised of the President, Vice President, Cabinet, and other federal agencies. Their job is to enforce. The judicial branch is comprised of the Supreme Court and other federal courts, and their job is to interpret. For our purposes, we'll mostly be talking about the judicial and legislative branches, in addition to one other important player, the Federal Reserve. Created in 1913, the Federal Reserve is the centralized and independent bank that's stated mandate is promoting maximum employment and stable prices within the economy. They do this by increasing or decreasing federal funds rate, which is the interest rate at which the depository institutions trade federal funds with each other overnight. These rates in turn affect the rates at which banks lend to their clients, which are you and I. One of the key things to remember about the Federal Reserve is that it acts as a nonpartisan player in the government, but it is accountable to Congress, as Congress is granted the power of the purse through the Constitution, which means it's their job to allocate federal funding. So we've set the stage and we understand the basics of how the federal government works. Let's get more specific on what the federal government's spending and revenues look like. Here's a graphic showing the 2024 federal budget. There are three broad categories of spending that we break down. Those categories are as follows: mandatory, which is funding that is authorized by permanent law via Congress. Next is discretionary, which is funding that can be adjusted annually via Congress. And the final category is just net interest, which is just interest payments on outstanding debts. Within mandatory spending, we see things like Social Security, Medicare, and Medicaid, while discretionary spending is simply broken down into defense and non-defense. Unfortunately, like many modern American families, what's going out far surpasses what's coming in. In fiscal year 2024, the federal government brought in $4.9 trillion through taxation revenue, with total outlays coming in at $6.8 trillion for 2024. It left us with a $1.8 trillion deficit. Since we don't have the revenues to support the costs incurred, the $1.8 trillion gets added to the national debt, which now sits at approximately $38.3 trillion. To ensure our terms are clearly defined, we refer to debt as a financial liability or obligation owed by one party, called the debtor, to another, the creditor. This debt is comprised of principal, which is the original amount borrowed, and interest, the cost of borrowing the money. Terms of borrowing vary in different ways, and the federal government doesn't borrow money like we do, but the general idea is the same. Money borrowed to pay expenses now with an agreement to pay it back in installments over time. If you've ever financed anything or left a balance on a credit card, you can look at the breakdown on your statement to see the theoretical circumstance on paying the minimum payment and how long it would take to pay the balance off if you were to only make that minimum payment with no new spending. Interestingly enough, the federal government's payments on its debt does not include any principal, only interest, which makes it incredibly difficult to make any headway on the debt. In addition to that, the federal government increases the deficit every year, making the debt problem balloon. To simplify, let's consider this in terms of an average American family. We'll just take off some zeros to simplify, but keep the relative values the same. Let's divide everything we're talking about by a cool 100,000. Imagine a family made $52,000 per year. They had the typical expenses of housing, vehicles, food, etc., and they spent $70,000 each year. Imagine now that this family had kept this same pattern of spending more than it earned since 2001, adding various amounts of debt annually while an increasing portion of their yearly revenue went to supporting their previous year's debts. Now imagine this family making $52,000 per year and spending more and more each year had a debt balance of $380,000. Finally, imagine that in addition to the excessive spending, to simply pay the interest on the debt notes, meaning nothing toward the principal balance, it took almost $10,000 of that $52,000 per year. Now, maybe we can start to see the root of the issue. Knowing these numbers and scenarios, you may be wondering, how does it all keep working? What keeps the wheels turning and the lights on? Most importantly, how does the federal government's spending affect your personal life and wallet? Well, it's complicated, but hopefully we can break it down in a way that helps to shed some light on the situation. One of the major byproducts of the Federal Reserve and excessive spending for average everyday Americans is a dirty word we call inflation. Inflation is when we have too many dollars chasing the same level of goods and services, causing the dollars to have less purchasing power. Naturally, when there's more of a thing, that thing becomes less valuable as it is more available. Now, when the Federal Reserve determines that it is warranted to increase the supply of money in the economy, they don't just print $100 bills and start mailing them out to banks. They increase the money supply electronically by purchasing U.S. Treasury securities or other financial assets from banks to increase the amount of money in the bank's reserves, thus crediting them with this new electronic money. This in turn leads to more borrowing and lending that happens through the banks to businesses and individuals. With banks having more money on their books to lend out, you're more likely to get auto loans, home loans, personal loans, you name it, you can probably get it at a more competitive rate. The relatively cheap money that can be leveraged by businesses and individuals alike leads to increased spending in the economy and growth. Or at least that's the idea. This is one of the reasons that the COVID shutdown was such a major force in the economy that still reverberates to this day. The Federal Reserve acted in a historic emergency fashion in response by lowering rates and ultimately growing the money supply by a whopping 27% between 2020 and 2021. This, of course, led to high inflation rates above 8% during this time. To add some context, the Fed's target rate of inflation from year to year is 2%. You may notice these tinges of inflation when you pay more for your groceries, when it costs more to fill up at the gas station, or if you own a business, your cost of goods are up. However, in a situation where the debt problem is spiraling, inflation becomes harder and harder to contain while managing the other aspects of our economy. While these things can be incredibly challenging to discuss, it is of utmost importance to understand as citizens who must demand the highest level of care and thought from those we elect to represent and guide us through these challenges. Until next time.